Are REITs still worth investing in during uncertain times? While many investors are fleeing to tech stocks or cash positions, healthcare REITs might be the hidden gem you're overlooking. Today, I'm diving into Parkway Life REIT's latest results, and what I found might surprise you. They've managed to grow the distribution despite market headwinds and an enlarged unit base. I'll show you why this healthcare REIT continues to deliver consistent returns year after year, and how their strategic moves in Japan and France are positioning them for even stronger growth. If you're looking for stability with upside potential in your portfolio, you'll want to stick around. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers with over 850,000 reads and 53,000 likes. I've produced over 800 videos with more than 350,000 watch hours as of February 2025. I also focus on regional and global economic trends. Today we're taking a deep dive into Parkway Life REIT's Q1 2025 results, their recent exit from Malaysia, and why healthcare REITs might be the defensive play your portfolio needs right now. Let's get into it. Let's start with the big picture before diving into the details. Parkway Life REIT, or PLife as it's often called, is a healthcare-focused REIT with properties across Singapore, Japan, and now France. They've just announced their Q1 2025 results, and there's a lot to unpack. One of the most interesting moves Parkway Life REIT made recently was their exit from the Malaysian market. Just yesterday, on April 21st, they announced the sale of their freehold strata units and lots in Malaysia for R20.1 million, which is about $6.1 million. Why does this matter? Well, this was their only investment in Malaysia, contributing just 0.2% to the trust's asset value. By selling these assets, they're streamlining their portfolio to focus on their core markets. The sale price is actually 25.6% higher than what they originally paid back in 2012 and 4.6% above the latest valuations. That's a solid return on investment over that period. Think of it like cleaning out your closet. Sometimes you need to get rid of items that don't fit your style anymore so you can make room for new pieces that work better with your wardrobe. In PLife's case, they're creating financial flexibility to pursue more attractive opportunities. What's particularly interesting is who bought these assets. Pantai Medical Center, a wholly owned subsidiary of IHH Healthcare, which happens to be a substantial unit holder of PLife REIT. This related party transaction makes sense strategically for both parties. Have you ever considered how important it is for REITs to maintain focus on their core markets? This move shows PLife's commitment to their asset recycling strategy, which has been a key part of their success story. Now let's look at the headline numbers from their Q1 2025 business update released today. PLife reported a distribution per unit DPU of $0.384 for Q1 2025, which is a 1.3% increase from $0.379 in the same period last year. While that might not sound impressive at first glance, there's more to the story. Their revenue climbed 7.3% to around $39 million, up from $36.3 million in Q1 2024. Net property income grew even more at 7.5%, reaching $36.8 million compared to $34.3 million previously. The most impressive figure, their distributable income jumped 9.1% to $25 million, from $22.9 million in Q1 24. So why didn't the DPU grow as much as the distributable income? The answer lies in the enlarged unit base following their equity fundraising exercise to acquire their portfolio in France. More units means the same pie gets divided into more pieces. Think about it like this. Imagine you have a pizza that's 10% larger than last year, but you need to share it with 8% more people. Everyone still gets more pizza than last year, but the increase per person isn't as dramatic as the overall growth of the pizza. What's driving this growth? Two main factors. First, contributions from newly acquired properties. 1 nursing home in Japan and 11 nursing homes in France that they acquired in the second half of 2024. Second, their Singapore hospitals being on step-up lease arrangements, which means built-in rental increases over time. These positive factors were partially offset by the depreciation of the Japanese yen, which affected the income from the Japanese properties when converted back to Singapore dollars. Does this remind you of the importance of having built-in growth mechanisms in your investments? Those step-up lease arrangements provide predictable income growth regardless of market conditions. Let's talk about PLife's expansion into France, which is a relatively new market for them. The acquisition of 11 nursing homes in France in late 2024 represents a significant strategic move. This wasn't a hasty decision. Based on reports, PLife spent more than 3 years planning and preparing before entering the French market. This careful approach shows a disciplined growth strategy. Why France? The European healthcare market, particularly for elderly care facilities, offers stable returns with long-term growth potential due to aging demographics. It's also a way for PLife to diversify beyond Asia and reduce concentration risk. The full-year contribution from these French nursing homes will only be reflected in the 2025 financial year, meaning we can expect further DPU growth in the coming quarters as these assets contribute for the entire period. Think of this expansion like planting trees in a new orchard. It takes time for them to mature and bear fruit, but once they do, they'll provide harvests for many years to come. Have you considered how geographic diversification can strengthen a REIT's income stability? By spreading across multiple markets, PLife is better protected against country-specific risks. One of PLife's strengths has always been their disciplined capital management, and this quarter's results continue to demonstrate that approach. Their gearing ratio stood at 36.1% as of March 31st, 2025, which is a slight increase from 34.8% at the end of 2024. This increase was due to additional borrowing for capital expenditure and working capital purposes, as well as appreciation of the Japanese yen. Even with this increase, they still have ample debt headroom of $424.1 million before reaching the 45% gearing limit. This gives them significant flexibility for future acquisitions without needing to raise additional equity. What's particularly impressive is how they manage foreign exchange and interest rate risks. The Japanese acquisitions are fully funded by loans in Japanese yen or Singapore dollar loans overlaid with cross-currency interest rate swaps. This means they're naturally hedged against currency fluctuations. Additionally, about 90% of their interest rate exposure is hedged, protecting them from the volatility we've seen in interest rates over the past few years. It's like having both a raincoat and an umbrella during monsoon season. You're prepared for whatever the weather throws at you. When was the last time you checked how your investments handle currency and interest rate risks? These factors can significantly impact returns, especially in a global portfolio. Looking ahead, one of the most exciting developments for PLife is Project Renaissance, the significant renovation and refurbishment of Mount Elizabeth Hospital in Singapore. This project is nearing completion and is expected to provide a substantial boost to DPU for FY 2026 and beyond. The upgraded facilities will command higher rents and strengthen PLife's position in the premium healthcare segment. Think of it as renovating a house. You invest money up front to increase its value and rental potential for years to come. This kind of strategic capital expenditure is what separates forward-thinking REITs from those that simply collect rent. Have you noticed how the best REITs don't just acquire properties but actively enhance their existing portfolio? This approach creates organic growth that doesn't rely solely on new acquisitions. What makes Parkway Life REIT stand out in the crowded REIT market? Several factors contribute to their competitive advantage. First, by concentrating on healthcare assets, they've developed deep expertise in this niche, allowing them to identify and execute on opportunities that general REITs might miss. Second, their leases typically have longer terms than commercial or retail REITs, providing income stability and visibility. Third, many of their leases include inflation-linked rent escalation clauses or step-up arrangements, ensuring organic growth even without new acquisitions. And fourth, healthcare services remain essential regardless of economic conditions, making their tenant base more resilient during downturns. It's like owning a business that sells necessities rather than luxuries. People might cut back on shopping or dining out during tough times, but they still need healthcare services. Do you have defensive assets in your portfolio that can weather economic storms? Healthcare. REITs, like PLife, can provide that stability while still offering growth potential. Based on the current trading price of $4.20, as of April 22nd, 2025, Parkway Life REIT offers a forward dividend yield of approximately 3.6% for 2025 and potentially 4.2% for 26. While this yield might seem modest compared to some other REITs, it's important to consider the quality and stability of the income stream. PLife has increased its DPU every year since its IPO in 2007. That's 17 consecutive years of growth, an impressive track record that few other REITs can match. The current price represents a potential upside of around 8.75% to the target price of 460 thumb, suggesting a reasonable entry point for long-term investors. Think of PLife as the tortoise in the race against the hare. It might not deliver spectacular short-term gains, but its consistent performance compounds over time to create significant wealth. When evaluating REITs, do you focus too much on current yield and not enough on the consistency and growth potential of that yield? Sometimes the most reliable performers don't have the flashiest numbers. If you're building a balanced portfolio, having a core holding like PLife can provide stability while you take more calculated risks with other investments. It's like having a solid foundation for your house. It might not be the most exciting part, but everything else depends on it. Let's zoom out and consider how PLife fits into the current economic landscape. With ongoing global uncertainties, including inflation concerns, geopolitical tensions, and potential market volatility, defensive investments are becoming increasingly attractive. Healthcare REITs like PLife offer several advantages in this environment. They provide inflation protection through built-in rent escalation clauses that help maintain real returns during inflationary periods. They focus on essential services, as healthcare demand remains relatively constant regardless of economic conditions. And they benefit from aging demographics, as the long-term trend of aging populations in developed markets supports sustained demand for healthcare facilities. It's like having an umbrella business. When economic storm clouds gather, demand for your product actually increases. Have you reassessed your portfolio's defensive positioning lately? With market volatility potentially increasing, having stable income generators like healthcare REITs could help you sleep better at night. Let's recap what we've covered today about Parkway Life REIT. First, they delivered a solid Q1 2025 performance with a 1.3% increase in DPU despite an enlarged unit base, showing their ability to grow distributions consistently. Second, their strategic exit from Malaysia demonstrates their disciplined approach to capital allocation, focusing resources on their core markets with better growth potential. Third, their expansion into France represents a significant growth opportunity, with the full benefits yet to be realized in upcoming quarters. Fourth, their prudent capital management, with effective hedging strategies for both currency and interest rate risks, provides stability in uncertain times. And finally, with Project Renaissance nearing completion, there's a clear catalyst for future DPU growth in 2026 and beyond. If you're looking for a defensive investment with a proven track record of consistent growth, Parkway Life REIT deserves a place on your watch list. Their focus on healthcare real estate, disciplined management approach, and clear growth strategy make them a compelling option for long-term investors. What do you think about healthcare REITs as an investment? Are they part of your portfolio strategy? Let me know in the comments below. If you found this analysis helpful, please hit that like button and subscribe to the channel for more investing insights. And if you're interested in learning more about defensive investing strategies, check out my recent video on why defensive stocks are your best bet right now. I'll link it in the description. Until next time, this is Iggy from the Investing Iguana, helping you navigate the financial jungle. Happy investing!